Hello and welcome to today's Cabot Wealth webinar, Finding Early Stage Growth Stocks Before the Crowd. I'm your host, Chris Preston, Chief Analyst of the Cabot Wealth Daily Advisory and Managing Editor here at Cabot Wealth Network. With me today is Tyler London, Chief Analyst of our Cabot Small Cap Confidential Advisory, as well as our newest advisory, Cabot Early Opportunities. And today Tyler's here to talk about the strategy behind the new advisory, his methodology for uncovering early stage opportunities, small cap or otherwise, past early stage winners, and stocks that are on his radar now. This is an interactive webinar, which means we'll be fielding your questions after Tyler's presentation wraps up. So if you have a question, feel free to ask it at any time, and we'll try and get to as many of them as time allows once Tyler wraps up. Just keep in mind that we cannot offer advice in regards to your own personal investing situation or portfolio. First, let me introduce Tyler. Tyler spent his entire career managing, consulting, and analyzing startup and small cap companies. Prior to joining Cabot, Tyler founded and operated a small business for 15 years. He then worked as a consultant for startup technology companies, as well as Vermont's largest healthcare institution. From 2009 to 2015, he was the chief analyst of growth stocks at Wyatt Investment Research, where his research spanned the full spectrum of the growth stock universe, from micro-cap startups to multinational mega-caps. Tyler joined Cabot in 2015, and his Cabot Small Cap Confidential portfolio currently boasts an average return of 76% on 15 positions at a time when small cap stocks are lagging. They're up less than 3% in the last year. Now, he's hoping to continue his stellar performance with Cabot Early Opportunities. Tyler holds a BS and MBA from the University of Vermont, where he graduated valedictorian. He has been a long-time contributor to Wall Street's Best Investments, has been quoted by U.S. News and World Report, and has presented investing ideas and strategies for The Money Show and Bloomberg Markets Live Insights. Long story short, Tyler knows what he's talking about when it comes to stocks, so I'll let him do just that. Tyler, take it away.
All right, thanks, Chris. So I'd love to do three things today. We'll talk a little bit about the two advisory services that I manage here at Cabot, and then go through my process for finding stocks. Then I want to show a few examples of what's worked in the past and kind of tie that into the process, and then look at some stocks that I think look good right now. And then we'll take some questions, of course. So to kick things off here, really everything that I do at Cabot on a daily basis feeds into trying to find early stage stocks to recommend now in Cabot Early Opportunities and Cabot Small Cap Confidential. So we're really, when we came up with the idea for Cabot Early Opportunities, we really wanted to design a process or a product that helped narrow and target this process. So what we came up with is Cabot Early Opportunities, or CEO, is an idea generator for pure play early stage growth stocks. And we are looking for big opportunities in young companies in a relatively large asset class of small and mid cap stocks that have market caps, from literally, $0 all the way up to $10 billion. So a pretty large universe within, sort of the small and mid cap asset class. In terms of the content that I'm trying to put out to subscribers, I'll get into the company overview, so the big idea and the story, talk about the fundamentals, talk about the stock chart, why we like that and what looks good. Really trying to put out an easy to digest, consumer friendly advisory service that's kind of fun to read, but also gets you into some of these great opportunities early. Transitioning to Cabot Small Cap Confidential, this is a portfolio of my highest conviction stocks, so stocks that would be appropriate, in my view, for rather significant position sizes. Small and micro cap stocks. It has a little bit narrower universe than CEO, Cabot Early Opportunities. So I'm looking at kind of your traditional small cap asset class area, so 250 million up to 3.5 billion. And I'm doing institutional quality deep dive research reports, trying to leave no stone unturned so that you really have the confidence to invest a decent sum of money in these stocks, and then managing a model portfolio as well. In terms of the content in Cabot Small Cap Confidential, subscribers will get everything in CEO, but then also more of a overview of the products and services of the company, talk about the industry analysis, the business model, and then the competition risks and the valuation. And then I do weekly updates for Cabot Small Cap Confidential with buy, sell, hold ratings, as well as anything that's happened with all of the companies. So with that as kind of the backdrop of, all of the work that I'm doing is trying to feed into these two products, let's talk a little bit about the methodology that I use. As I said, for CEO, I'm looking at stocks from 0 all the way up to $10 billion market cap. So that's a big universe. It's obviously kind of unmanageable. So I have to winnow that down to something that is manageable. So I'll do a number of proprietary screens that I've come up with, and I develop these, every quarter, so I'll kind of tweak them using William O'Neill's Pan-Array solution. I'll show you what that looks like in a few minutes when we get into some individual stocks, but it's a nice, powerful, institutional quality research platform that helps go through stocks quickly. I'll also scour investment bank research, see what the analysts that I respect are saying, not only about individual stocks, but also I enjoy reading their thematic research reports because it helps me understand, what the big money is doing, and then we can try to kind of invest appropriately, sometimes in the same stocks, but also finding smaller stocks that are kind of more of a leveraged play on a trend that the big banks are really liking. I also track a number of small and mid-cap funds. I've got nothing against mutual funds. Two of the ones that I follow pretty closely come from Brown and Conestoga, and these are really high conviction, targeted small and mid-cap funds that have like 50 to 75 positions in each fund. So really high conviction by management of the funds, and they're a good place to go in and pull out names that could work for us. And then of course I do a lot of IPO research. There's a lot of stuff coming public every month, and it's good to have a handle on that. We're not necessarily jumping into IPOs, on day one, but particularly in Cabot Early Opportunities, we might be within like 2 or 3 months of a company going public. So it's good to have a handle on that. So at the end of the day, I'm doing a mix of top-down kind of thematic research and bottom-up fundamental analysis to find stocks in that 0 to 10 billion market cap range that kind of are at the intersection of those sweet spots of great trend and great fundamentals, or at least great developing fundamentals. And all of that research at the end of the day results in a watch list of stocks that I'm constantly managing, looking at it on a weekly basis, taking stocks off, adding stocks on. I'm pretty familiar with the stocks on my watch list now and the universe, so I'm not adding that many on a weekly basis, but for instance, I just updated it yesterday and added 15 or so new stocks. So that gives you some sense of the universe that I'm following on a weekly and monthly basis. In terms of what I look for, big picture, the first thing is I'm always looking for a story and a big idea that sounds right to me. And what sounds right to me might not sound right to everybody. And conversely, there are some things that, analyst consensus is very positive on that just doesn't sound right to me. I think at the end of the day, to be a successful investor, especially an early stage investor, you have to have conviction in the stuff that you're buying, and there's going to be corrections in the market and in stocks. And for you to hold on to even a partial position in an early stage stock to have it do really well over the long term, you have to have conviction, and that's going to come from you sort of getting it. So I'm looking for stories and big ideas that sound right to me and mesh with the secular growth trends that I'm following and that make sense to me. A few examples that I talk about, in all of the material that I put out for Cabot is cloud software, medical technologies, financial technologies or fintech, payment platforms, those kinds of things. A lot of, plays on digital trends there, but these are some of the things that I'm watching. And then in terms of stock specific stuff, revenue growth and earnings growth of 20% or more is a pretty typical threshold for me. That's not to say I won't go down a little bit, I will. And, a lot of times it's well above that and, the 40% revenue or 60% revenue growth range. And then of course, I'm always looking for a good chart, a good leading chart with good momentum. That's not to say that we won't buy stocks on a pullback. We will, but those pullbacks have to be in the greater context of a chart that looks, good on, a 52-week or longer time frame. Not getting into deep value stocks here that have, kind of horrible looking charts where people are trying to pick them up at the bottom. That's not part of my process. In terms of more specifics, deep dive analysis, and this gets a little bit more into Cabot Small Cap Confidential. It's really important to me for a company to have a business model that I understand and that is built for incremental, sustainable growth and durability. So at the end of the day, I'm looking for management teams that are building businesses for the long haul. And that typically means they're able to benefit from catalysts and events that are positive, numerous, and repeatable. What I mean by that is I'm always looking for management teams that are doing things like new product development, putting out new products, new services, growing through M&A, repeatable M&A strategies, putting out initiatives to cross-sell products, to release products that expand the addressable market. All these kinds of things that will build a larger, more successful company with a rational go-to-market strategy that are all sort of feeding into this, incremental growth business model that's designed for the long haul. That ties into finding companies that have scarcity value. So at the end of the day, we're looking for early stage stocks here. These are typically rare opportunities that are not easily emulated. They have business models that aren't that easy to copy. Maybe they're new or different or a tweaked version of something that's been shown to work in the past, but it's new and better for now. And so that scarcity value is something that I pay quite a bit of attention to. And then at the end of the day, I am a stock picker, so I am fully recognizing that everything that I put out to subscribers is based on my subjective analysis, right? So these aren't, pure number-based screens where I'm putting out 15 or 20 stocks that meet a certain set criteria with no analysis whatsoever. It is definitely subjective analysis, and I think that's a good thing because it leaves room for different opinions to enter. I might like something, as I said earlier, that another analyst doesn't, and that creates opportunity when you're looking at early stage stocks. So let's go through a few examples of what's worked in the past, and naturally I'm going to pull success stories out here. Not everything that I've ever recommended has worked, obviously. In terms of managing downside, quick note on that. We'll typically get out in Cabot early opportunities when a stock is down 20% from our entry point. It's time to just step aside. In Cabot Small Cap Confidential, we give a wider rope of 30% down, then we step out. Going through the learning examples of what hasn't worked in the past is a different presentation. Today, tying things together, let's look at some things that did work. So Ambarella, ticker symbol is AMBA. This is a company that's still out there, semiconductor stock. We got into Ambarella way back in 2013 at about $15. This was a play on GoPro, if you remember that stock, kind of a go-go growth stock in 13, 14, 15, totally flamed out, as did Ambarella. But liked Ambarella as a way to play that because Ambarella was making the chips for GoPro as well as for dash cameras, and it was putting up 20% growth. So a hardware stock, ran all the way up, we were well over 600% gain, big correction, we got out. I recognize this is a cyclical stock, which I typically don't go for, but in this case did. And then, the stock shot back up to all-time highs, but then eventually collapsed. We got a little bit lucky getting out of this one at the right time. But going back to the beginning, it fit a big picture theme, and it had the 20% growth that I was looking for. Susser Holdings, total opposite end of the spectrum, kind of a boring stock. When I first put this one out there, some of the people that I worked with were, wondering why I was interested. It had the ticker symbol SUSS. It was since been acquired, so it's not not public anymore. But Susser Holdings ran a chain of convenience stores in the Southwest, predominantly Texas. And I've always been interested in the convenience store for reasons that I won't get into now, but really incremental growth, selling both gasoline and then, chips, snacks, soda. They also had some small restaurants, so tacos, burritos, that kind of thing. But they were putting up 20% quarterly revenue growth, growing through M&A with a really durable acquisition-led growth strategy across Texas in a market that, this business model really worked for. And so we got into this stock and rode it until it was acquired and did pretty well on it. But again, I bring this one up because it's totally the opposite of Ambarella. It's not a go-go growth stock. It's a relatively boring company. But my point here is that when you look at the business model and you understand where the growth is coming from, starting with 20% revenue growth, that faded over time, but the company became profitable and had a steady growth profile, you can do pretty well. Everbridge is kind of in the middle. We got, Everbridge is ticker symbol EVBG. We got into this one shortly after the IPO at around $15. What they do is they sell software that automates critical response to events like in severe weather, active shooter events, terrorist attacks, all the kinds of things that we hope never happen, but unfortunately do. And so Everbridge has a platform that helps send out population alerting notifications, helps with emergency response, helps people who are in situations where they need help to get help. There's some really interesting use case stories on their website about how in New Jersey, users of the software helped apprehend somebody who had been out trying to do pretty nasty things. But at any rate, so Everbridge we got into, liked the stock because big picture sounded great, had scarcity value. There aren't that many small cap companies out there or even large cap companies with this type of technology, and it was putting up great growth numbers. Rode it for a while. I put on here this 33% correction, wanted to highlight that because as I said earlier, when we're talking about business model and durability, we are going to go through phases where there's big corrections in these stocks, and if you're holding them, you're going to question, is this a stock that I want to stay in? And you have to have enough knowledge of the business and the business model to have the conviction to stick with it, or conversely, to recognize that it's actually not built to sustain growth through whatever turmoil is happening at the time. We've had good feelings for Everbridge and are actually still in it. It's up well over 400% now. Deciphera Pharmaceuticals, ticker symbol DCPH. This was a relatively recent recommendation in Cabot Early Opportunities. You can see the arrow there around 34.42 we got in, so it's up 38-40% since. So the story here is Deciphera develops therapies for various forms of cancer. And the story I wanted to share here is that, as you can see, there was this big gap up in August where the stock jumped from, on the day, it jumped on from 20 to 42, so well over 100% gain on that day. What happened was positive phase 3 data came out for one of the trials. So we kind of got a little bit lucky here, at least in the short term, waited a little bit. The timing of when I wanted to put this out worked well with the publication date for Cabot Early Opportunities. So, but big picture, liked the stock, liked the story, and really had higher conviction in it because of that phase 3 data. One could easily argue that you would have wanted to buy this stock before this big pop, but the truth is that if you're investing in biotech stocks before you have solid phase 3 data, the chances of success of those molecules ever getting to market in a treatment are much lower, like in the 40-45% range for phase 2. Once you get into good phase 3 data, they jump to closer to around 80%. And so that's where we are now with Deciphera. And the stock has continued to do well because it's starting to look like this same potential treatment could work for a wider range of indications. That story is still developing, but we're relatively new to it.
Tyler, let me just interject just for a second. Just to remind people, if you do have questions, you can send them in now, just in the question box that's on your control panel, and we will get to them as soon as Tyler wraps up. Carry on.
Okay, thanks, Chris. So in terms of things that I'm looking at now, Zendesk is a stock that I've been pretty bullish on for a while. Ticker symbol is ZEN, market cap of 7.9 billion. Zendesk isn't really a new name, but I put this one up as an example of a company that big picture sounds great to me. It sells software, customer service software that helps enterprises, large organizations engage with their customers. You know, we live in a digital age. This company has been developing products since 2007 that have been working really well. It is transitioning now. It's not like early stage. It's transitioning more to like a mid-stage company. And it's, in my opinion, kind of covering that chasm to become what could be a truly large cap success story. And there's not that many companies that make it that far. When you see 20% revenue and earnings growth with positive earnings that just came in recently, with a company like this, Zendesk starts to look pretty attractive. So on this slide, if you look down at the bottom here, you can see the quarterly numbers. They're a little bit hard to see, but I believe we'll be sending out this presentation later and you would be able to, you know, pause the video or whatever to look at those more closely. But for right now, I exploded the annual numbers. So for 2019, we're looking at revenue growth of 35% and then still up 31% in 2020. And in terms of EPS growth, we're looking for 39% this year and then 78% in 2020, when EPS should be around 57 cents a share. So a significant pullback in the stock, which is, you know, pretty typical of software stocks since their summer highs. Zendesk was kind of in the 30% range, again, pretty typical for this type of stock. But if you look at the chart over the last week since earnings, it's definitely looking more constructive. So I think Zendesk could be something that shouldn't be overlooked. Guardant Health, ticker symbol is GH, market cap of around 6.8 billion. So Guardant Health, big picture, I like. They are developing non-invasive cancer diagnostics, and they really specialize in liquid biopsy tests, which is a growing market. So it was a pretty hot stock when it went public last year at $19. It's up to around 73 now, even after a big pullback. So obviously a pretty popular company, firmly in like the smallish mid-cap range. So again, transitioning into becoming a little bit of a larger company, but still pretty early stage. I mean, the company was just, you know, founded in 2011. In terms of the numbers, revenue growth in 2018 was 81%, should accelerate to around 133% this year, and cool off a bit, you know, because they're not going to have the same new product releases in 2020 as 2019, but still 30% growth. Not profitable. It'll take some time for Guardant to get profitable, but nevertheless, a pretty attractive opportunity in my view. And again, the stock had a significant correction from summer highs, but has been rebuilding off of, you know, the lows of the mid 50s from early October. Back to Everbridge. I talked about this as an example of something we've already had success on. And I put it up here because Everbridge market cap right now is around 2.6 billion. A lot of people would look at this and say, you know, if they looked at this for the first time and say, well, this is definitely an early stage stock. Some of my subscribers might not, because we've been in it since 2013, but you step back and it is very much an early stage stock. It's growing revenue. You know, 2018 revenue was up 50%. should be up 33% this year and then 30% in 2020. We haven't even gotten to the transition to profitability yet. That's probably going to be, you know, a mid 2020 on a quarterly basis, 2021 on a annual basis. That transition to profitability for a small cap software stock is typically extremely well received, carries lower risks, and it's a stock that mid cap funds can start to buy. So here we have Everbridge, you know, peaked this summer at 104, pulled back all the way down to 60, big correction. Was still 25% off highs at around $80. I think it's up a little bit above that now. But like Garden, like Zendesk, a growth stock that's starting to come back a little bit that I think a lot of small cap funds are looking at now again, and mid cap funds will be looking at soon. I haven't talked about Q2 Holdings yet today. Ticker symbol is QTWO, market cap of 3.5 billion. This is essentially a fintech stock. It sells cloud-based virtual banking software to primarily credit unions and small banks, although it is moving up market a little bit. But it sells both platform technology for, you know, online banking platforms for credit unions, but it's also getting into more kind of corporate and business development products. It recently acquired Precision Lender, which will help kind of on the corporate side with selling. I won't go any deeper into exactly what it does, but just stepping back to look at the numbers, revenue growth in 2018 was 26%, should be accelerating to 33% in 2019. And then we have 25% in 2020, but that's not factoring in the acquisition of Precision Lender, which should add a little boost. And if my hunch is accurate with cross-selling opportunities and some of the other business development stuff that's going on, I think 2020 numbers could prove, these 2020 numbers could prove to be quite conservative right now. In terms of earnings, in 2019, we do have an earnings dip, 54%, but you have to understand what's going on in the company. So there are implementation costs to get big new banks online, get those projects online, get them up and running. And so there's a lot of costs baked in there, as well as some acquisition related stuff. So that's why you see a dip in earnings this year, then projected to be back up over 200% to around 37 cents in 2020. And then the last new stock I have for today is Digital Turbine, ticker symbol APPS. So much smaller company, market cap of around 616 million. So big picture, Digital Turbine has developed a platform that helps with mobile content distribution, so basically applications on Android platform. So not on iPhone, but on Android. So Samsung, TracFone, those kinds of devices. It is also delving into other mobile device app distribution, including television, and then also, you know, iPads and those kinds of things. So basically what they'll do is they'll work with the carriers like Verizon, AT&T, and then also the device manufacturers, so that when the consumer goes out and gets the new device, it's very easy for that consumer to find the applications that they want to use that fit their profile. That's what Digital Turbine does. And so growth has been really attractive. Fiscal year 2019 is already in the books. Revenue was up 43%, earnings of 8 cents a share. All this information is in this little box right here. And then revenue growth should be up around 30% this year, with EPS up 138% to 19 cents a share, and then 23% revenue growth next year. So again, a small company, a couple of deals could definitely move the needle here. So take these estimates with a grain of salt. But when you step back, big picture, kind of a digital play on mobile device growth, but also other sorts of digital content distribution with applications across TV and other sorts of devices. Digital Turbine is right in there, and it has a pretty attractive chart as well. So again, stepping back, so the two products that I manage are really all about finding early stage stocks when they're in that kind of 0 to 10 billion market cap range, and getting that research out to subscribers. In Cabot Early Opportunities, we're focused on putting out, a lot of details on watch list ideas. So idea generation product focused on the big idea, the story, showing you why revenue growth and earnings growth will be around 20% or more, and then discussing the reasons behind the stock chart strength. And then in Cabot Small Cap Confidential, going in deeper to the business model, the durability, catalyst, scarcity value, and then the opinions around whatever management is doing. And Chris, I think that's all I have.
Yep, let me just, sorry, just was unmuting myself. Yeah, we're gonna move on to question and answer, but first I'm gonna give Tyler a chance just to catch his breath for a minute here. And I'm gonna tell you how you can sign up for Cabot Early Opportunities if you're interested. So you can invest alongside Tyler by subscribing to his brand new Cabot Early Opportunities Advisory. First, you'll receive an email in your inbox with a special discount offer reserved exclusively for today's listeners. And new subscribers can try Cabot Early Opportunities for just $1 for the first month. That's 30 days. You can cancel at any time. And again, that's just for anyone listening to the webinar today. And when you subscribe, what you get is a monthly issue revealing 5 of Tyler's best early stage growth stock recommendations with special bulletins as needed throughout the month. Plus, you get personalized customer support and access to Tyler's personal email address in case you have any investment questions. And again, you should receive this special offer in your email inbox. Okay, let's move on to the questions. Let's see. Let's start with, here's one. Tyler, you mentioned IPOs. Would you get in right at the beginning after a company comes public, or wait for a trend to develop first?
Okay. Excellent question. I think in some ways it almost depends on the specifics. That's just a general rule. I would typically wait until what we see here, which is the post-IPO pullback, kind of approaching when lockup expiration will be, because I think we see this sort of euphoria. You see that this is Dynatrace, a company that went public in I guess the end of July. So it popped, a lot of euphoria, stock pulls back, and then you have this kind of consolidation phase where not a lot is happening, and then typically you'll start to see a little bit of an uptrend. So generally speaking, I would say that this is the sweet spot that I'm looking to get in. I don't necessarily have to wait until after lockup expiration. I know that a lot of investors will wait for that. I've read some pretty compelling statistical research that you don't really have to wait until after lockup expiration, because a lot of that news, it's known that is coming. A lot of that news is factored in earlier. And for those that don't know, lockup expiration is just when insiders are allowed to sell more shares, and sometimes lockup will be phased over, a 12-month period with certain milestones.
Okay, good question. Here's another clarifying question. Would you ever go higher than a $10 billion market cap if the right early stage opportunity developed?
Yes, definitely. Yep, easy to answer there. I think it depends on, for me, there's a lot of large cap companies that I love. Microsoft is a great example. Obviously, that company doesn't have a place in either of the products that I manage. But in Cabot Early Opportunities, if we want to get up into 12, 14, 15 billion market cap, and it's early stage based on, some subjective definitions, of course, but if it's in there, then yes, absolutely, I'll include it.
Okay, good to know. It's sort of was a broad question. What would you say is the biggest philosophical difference between Cabot Small Cap Confidential and Cabot Early Opportunities?
That's a good question. It's actually not that difficult to answer, though. Philosophically, Cabot Early Opportunities, the way I want to put that product out is it really is sort of an idea generating product. So trying to put out 5 stocks every month that all look great at that particular point in time. Most people that invest, using my methodologies probably won't buy 60 stocks a year, which, if you just do the math, Cabot Early Opportunities, 5 stocks a month, 12 issues, that's 60 stocks. That's an awful lot, especially if you're trying to run a pretty targeted portfolio. So Cabot Early Opportunities is really an idea generating service to try to put out what looks great every month across my coverage universe. Cabot Small Cap Confidential is that taken like to the next level. Super high conviction in one stock. So 12 stocks recommended every year, but with full coverage every week of all those stocks, including all previous recommendations in prior years that we still hold. So ultra high conviction, best stock to buy at that one point in time for the next, hopefully 3, 5, 10 years.
Okay. You mentioned you have a 76% return, Cabot Small Cap Confidential. Do you think this can produce the same kind of returns
in the future? Well, I guess the question is probably, can Cabot Early Opportunities produce the same types of returns? So those returns in Cabot Small Cap Confidential, as you would suspect, don't just cover stocks recommended in the last couple of months. There are some stocks in there that are up 300-400%, which definitely helps pull up the average. We have some stocks recommended in 2019 that are up, 150% or 50%, which are also helping to pull that up. But we also have a lot of stocks that are well below that average. So it will take time for Cabot Early Opportunities to even be able to come close to having an average gain of 70% or so. But I would think that the stocks, if we fast forward 2 or 3 years, the stocks that, the short answer is yes. We will get rid of stocks that fall off, that don't look good before they really detract from returns, and we'll keep those stocks that are doing well so that they add to returns. And so I think following the same sort of portfolio management style, albeit with a much wider group of stocks, I would think that we could have similar returns in both products.
Okay, we'll do a couple more questions. Here's a market-related one. With the market at all-time highs right now, does that make you more or less reluctant to search out early-stage opportunities?
It doesn't. Neither, really, to be honest. I think. Hold on, I'm going to pull up a chart of IJR. So this is the iShares S&P 600 small cap index. As you can see here, this index has been just going sideways in 2019. We hit, we're 2% off of highs, but it's still, if we bounce back to the weekly chart, you'll see that at $80, this ETF, which tracks the S&P 600 index, is still 10 points from its all-time high. So we're not even back to all-time highs in the small cap universe. What happens in large caps and small caps isn't totally related, but at the end of the day, I'm not looking for stocks that are just going to succeed or fail based on what the S&P 500 stocks do. I mean, there are always going to be outlier stocks that post market-beating performance, not totally regardless of what the broad market does, but within a certain range of potential market outcomes will outperform. And those are the stocks that I'm focused on, stocks that have, secular growth trends, which by definition means they should grow, again, not regardless of what the broad economy is doing, but, to a reasonable extent regardless. So a company like Everbridge, for instance, demand for population alerting software solutions isn't necessarily tied to GDP. It's more closely tied to, state spending budgets on population alerting. And speaking more globally, like there's a mandate in Europe for countries to implement population alerting solutions. And so, long-winded answer, but what the broad market is doing certainly matters in like the short term, but in terms of finding early stage stocks, I mean, I'm going to be doing this, day in and day out, regardless of what the broad market is doing. And there's always going to be a good stock to buy, in my opinion.
Okay, last question. This covers a little bit what you've already talked about, but what is the biggest characteristic you look for in an early stage growth stock?
The biggest characteristic for me would be a rational business model that's built for durability. And the reason is because basically everything else feeds into that. That includes, inherently management style, management vision, ability to develop products that are rational to meet market demand. It inherently involves rational pricing structure for products that you're putting out there. It really encompasses so many different things. So it's also one that you can't really just screen for. It's more of a subjective and qualitative thing, which I sort of like that from a stock picker's perspective. But yeah, it would be a business model that's rational and seems built for durability.
All right, good answer. Well, thanks, Tyler, and thanks to everyone for joining us today. We'll be back next month on December 11th at 2 p.m. Eastern again with another webinar, this time featuring our options expert, Jacob Mintz, editor of our Cabot Options Trader and Cabot Options Trader Pro advisories. It's titled Boost Your Profits with Covered Call. Covered Call is an options strategy that he'll be talking all about. So mark that on your calendar, especially if options are something you've thought about but haven't gotten into yet. In the meantime, again, watch your inbox for a special offer to Cabot Early Opportunities today as a reward for joining us on our webinar. And that does it for us. For Tyler London and the entire Cabot Wealth Network team, I'm Chris Preston. See you next time.